Good morning. You're watching a live market outlook for Thursday, 10th of November 2011, prepared by Windsor Brokers. Italy is now main subject and in the world markets as the crisis broke out, moving from Greece, and actually Italy replaced Greece at the center of the crisis after yesterday. Prime Minister Berlusconi announced that he is going to resign, but he insisted on elections instead of interim government that is prolonging actually current instability. He lost his majority in the parliament vote, and he confirmed he would resign after implementing economic reforms demanded by the European Union. And they also said that Italy must hold an election in which he would not stand. He opposed the form of transitional or any unity government, which the opposition and many of the markets favor, and said the polls were not likely until February, leaving a 3-month policy vacuum, which basically could create chaos in the markets. The political, economic, and non-economic crisis in Italy is actually increasing fears now of a split in the Eurozone, with borrowing costs for Eurozone's third biggest economy reaching unsustainable levels, and making the bloc unable to afford the bailout. The escalating crisis prompted European Commission President Barroso to issue a warning of the dangers of splitting the zone. The EU sources said that French and German officials had held discussions on just such a move. So there are scenarios now preparing, under preparation for the worst possible scenario, which would be the split or dissolving of the European Union. German Chancellor Angela Merkel said in a call to arms, she said the Europe's plight was so unpleasant that deep structural reforms were needed quickly, warning the rest of the world would not wait. That would mean more Europe, not less Europe, she told a conference in Berlin yesterday. She called for changes in the EU treaties after French President Nicolas Sarkozy advocated a two-speed Europe in which Eurozone countries accelerate and deepen integration while an expanding group outside the currency bloc stays more loosely connected, a signal that some members might have to quit the euro. The Merkel said it's time for a breakthrough to a new Europe, a community that says regardless of what happens in the rest of the world, that it can never again change its ground rules. The community simply can't survive. The European Central Bank, currently the only effective body against the market attacks, intervened to buy Italian bonds in large amounts, but remained reluctant to go further, and Italy's 10 years bond yields shot above 7%, a level widely deemed unsustainable as investors' confidence evaporated. Yesterday's events, I would say, with Italy actually had a big impact on the markets, as triggered a sharp sell-off of euro, but also the commodities were heavily affected as gold and crude oil dropped. Investors are mainly taking good profits from the recent longs on especially gold as the safe haven instrument, and covering losses in the other markets that were likely triggered by heavy losses of euro. So this pushed the gold lower, testing some important support levels, as well as crude oil, as the initial supportive data from China yesterday are running now in favor of increased fears of further fate of the Eurozone. The outlook generally doesn't look good at all for now, and we'll be closely watching the further developments in especially in the Eurozone, as this is now #1 subject in the world. A brief look to today's calendar. Already events already released. Chinese trade balance dropped to 17 billion versus the forecasted 26.3 billion, and the previous month release at 14.5 billion. The French CPI, the inflation rose by 0.2% versus 0.1% forecast, while German monthly inflation remained unchanged. French industrial production also dropped significantly this month by -0.7% compared to a drop of 0.6% forecasted, and the previous month release growth showing growth of 0.5%. Still to come today is the Bank of England rate decision that is widely expected to stay unchanged at 0.5%, and the MPC's Bank of England MPC rate statement to come after. Across the ocean, the trade balance from Canada and the US, Canadian expected to increase by 0.5 billion Canadian dollars, while the US trade balance is expected to widen to 46.1. The trade gap is actually expected to widen by 46.1 billion US dollars compared to previous month one at minus 45.6 billion. Weekly jobless claims also coming at the same time at 13:30 GMT are expected to raise to 401,000 versus the previous week release of 397,000, and import prices are forecasted today to grow by 0.1% compared to the previous month growth by 0.3%. A number of speakers today at 16:45 GMT. The Fed Chairman Bernanke is having a speech. Then at 18:15, another FOMC member Janet Yellen is having speech today. This would be all from today's calendar. Now let's take a look on the most interesting, the recent market movements in the majors and commodities. Starting with the euro, as we can see, the pair broke below the recent consolidation range between 136 and 138.50, as the gains were firmly capped by 138.50 zone, which is also initially it was 38.2% of the 142.46 to 136.07 move, and the start of the breaking out the Italian crisis actually triggered the initial move lower that accelerated on break below a significant supports at 136.55 and then 136.0700, hitting so far levels under psychological support at 135 that was hit this morning. The outlook remains negative, as the studies are all in the negative territory. Oversold conditions on hourly and 4-hour. Hourly is already bouncing higher, are suggesting some corrective action, with the 136 coming as initial resistance ahead of 136.50 zone, where is also the broken trend line. We don't have it here. The broken trend line from 142.46 high that might bring it's approximately like this, that might bring some selling interest, while the 137 level is expected to cap the possible corrective attempt with the descending 20 days moving average on 4-hour chart currently at 137.07, also capping the upside. For the downside remains vulnerable on euro dollar, as the fundamentals are quite negative, and no expectations of some really positive news that might trigger some stronger corrective movement in the markets for now, as euro mainly remains driven by fundamentals. We see the downside favored for now, and the levels to watch on the downside is 134.27. It's 13th of February low. It's on the daily chart. 130. Uh, 13th of February low at 134.27, and then we have 133.61, the low of 26th of November. These are the levels to watch on the downside. Also, as the studies are getting weaker on the daily outlook, and the MACD already below the center line, favoring further losses of the pair, we might see the attack on the main bull trend line seen on weekly chart from 118.75, low of 2010, that currently stands around the 132.50 level. This is in the short-term focus, and likely to test if the situation in Eurozone becomes more severe. The British pound also lost the traction after losing initial support at 159.50, extending losses to 159 zone, testing actually the key support zone at 158.90 and 158.75, below which would put the recent rally from 152.71 aside and open way for a further reversal, as the upside remains capped by 200 days simple moving average, currently standing at 161.38, with the yesterday's second and third higher being running out of steam just ahead of this line, and the immediate reversal now is testing the downside, the floor of the recent congestion between 159 and 161.60, with the loss here coming to 158.43, which is the 158.50, the previous consolidation range ceiling, and 158.43 also the 55 days moving average on the daily chart, and then comes in this zone 158.24, the Fibonacci retracement of 152.71 to 161.64 ascent. The focus on the short term for cable remains negative, and the only break above 160 actually would improve the current negative tone. Dollar yen is in short-term recovery, actually is ending the short-term recovery mode after weakness broke below initial support at 78 and losing 77.75 and dipping down to 77.50, which is 50% retracement of the initial rally up, post-intervention rally from 75.56 to 79.52. The immediate risk remains at the downside as gains failed to regain 78, stalling at 77.87 late last night, and 77.50 is now in focus. Loss of which would maintain the bearish near-term outlook and look for further extension lower. 77 after break of 77.50, 77 comes in focus, and risks return to the August to October the August to October range between 76 and 77. However, the pending reaction of the Bank of Japan keeps some hopes that pair will be further supported, but at this point we are just about to wait to see if the Bank of Japan is going to intervene again in order to stop further growth of Japanese yen. Dollar Swiss maintains the positive tone, currently correcting the recent rally that cleared our initial resistances at 90.81 and 91.20, extending gains to 91.47 highs seen early this morning. The corrective pullback tests now 91.00 as initial support. However, the 90.00 zone is seen, 90.66 previous high and the 90.00 seen as initial support, and the loss of 90 actually would weaken the near-term structure. Reversal above 90 keeps the current strong rally in play and opens way for possible revisit of the previous high posted on 6th of October at 93.13. That is currently in focus. Commodities are easing again as uncertainty from Italy is overshadowing the recent yesterday's positive news from China, as crude oil dipped down to 95.64 after hitting a fresh high at 97.30. Immediate bounce there was quite choppy trading with the wide amplitude between 94.55 and 97.80. However, the market stabilizes now around the 96 zone, with the overall tone still in a positive field. Potentially seen for a further extension higher and the test of levels at 100 and 160. And for this we have the 100 and 160. The 100 days moving average, 200 days pardon, at 95.24 is currently containing the dips from the fresh highs at 97.81 and 97.05, with the focus more to the upside at this point. Gold also corrected latest gains that briefly broke above 1800 psychological barrier, hitting 1802.5 in 2 days ago on 8th of November. The current pullback is now testing our key support at 1750, where the temporary support was found, and potentially seen for further extension higher as the main short-term bull trend line drawn from 1603, a low of 20th of October, remains intact for now, is underpinning current gains. Daily outlook holds the positive tone, as 20 days moving average is now breaking above 90 days one, and 55 days at 1734 is keeping the downside protected. Clearance of 1800 opens 1828 and 1845, ahead of possible extension towards 1885, 1900 and the record high at 1920. The fundamentals again are going to play the main role in this, but usually the uncertainty in the world markets keep the gold as the main safe haven instrument, and the short-term outlook for the yellow metal remains in a positive field for now.